Welcome to What Will the Fed Do Next, a live webinar co-hosted by the National Association of Home Builders and ProBuilder Media, the official media partner of NAHB. Before we begin, I want to let our audience know that this webinar is being recorded and that recording and a free downloadable takeaway from NAHB will be posted to the webinar page on probuilder.com within a few days. That way you can rewatch it or share it with a colleague, and we encourage you to do that. I also encourage you to use the Q&A function on your screen to ask questions as we go, some of which I may interject into the discussion if it's relevant to what we're talking about, and I think it's a good point to discuss at that moment. Otherwise, we'll get to as many as we can at the end during a Q&A session. We're planning to go a full hour. We will keep it to that, but hopefully we'll have some time at the end to answer any lingering questions. Thanks again for joining us today, and let's get started. My name is Rich Binsaka. I am the editorial director at ProBuilder Media, and joining me today is Dr. Robert Dietz, the chief economist and senior vice president of economics and housing policy at NAHB. Rob, we're glad to have you. Thanks again for joining us.
Yeah, it's good to be here, Rich. Thanks for hosting.
You're very welcome. So I wanted to kind of start this. We kind of pitched this webinar as what will the Fed do next? And obviously, everyone who has any stake in the housing industry or the economy, which is pretty much everybody in the country, has been paying attention to the interest rate increases that the Fed has had over the last year or so. When we did our housing giant survey earlier this year, interest rates were the number one challenge, if you will, or concern among those housing giants, and it wasn't even close. Something like 77% of them said that was their number one challenge. The next was something like 34%. So obviously, it's a big topic on their minds. It's something that's challenging them in the new home market and the housing market in general. And so today's discussion is very timely. And before we got started, you had mentioned that there has been some action today, in fact, on interest rates. So we know that the Fed didn't raise rates at their June meeting. Their July meeting is coming up, or maybe I believe it's coming up, and they've said that they're probably going to raise interest rates. But tell us about what's been going on today, and kind of give us some insight into that issue just briefly before we get into the debt.
Yeah, I think what we've seen this week in particular, but over the last few weeks, is a rise in some of the short-term interest rates, which in turn has increased the 10-year Treasury rate. It is going to filter through and push mortgage rates higher. And what we're seeing basically now is Wall Street, and particularly the bond market, begin to accept that the Fed is not done. At the most recent Federal Reserve meeting, as you indicated, they did pause. But in their summary of economic projections, they indicated that on average, the typical voting member of the Federal Reserve indicated that we're likely to see 2 more rate hikes in that cycle. So the pace of increases looks like it's slowed, but they haven't reached what we call the terminal rate, the top rate on that Fed funds rate. So what does that mean for builders? Well, it means that likely we're going to see higher mortgage interest rates. I think there's an open question of whether or not we will get above the top rate that we saw last fall, which right now is the peak rate for the cycle. And we'll discuss that as part of this webinar. But it does mean additional challenges in the A, D, and C loan market, the cost of credit for private builders. And I think that is a concern. It's something I don't think the Federal Reserve is taking seriously, and we'll talk through this in terms of some of the interplay between monetary policy and where inflation's going. But the bond market now is taking seriously the idea that the Fed is not done, and it's likely to leave higher rates higher for longer.
Okay. Well, thank you for that. I appreciate that insight and that kind of breaking news and putting into perspective for our audience. Okay, so let's talk about this. Let's talk about fiscal policy, inflation, interest rates, starting with some of the key factors at work in the general economy.
Yeah, so we thought we would start this presentation just kind of look at the GDP outlook, and I think part of the interest rate surprise, part of the reason that you're seeing rates move higher here in mid-year of 2023 is that the recession call that many people had for 2023 is simply not happening. Now, that's good news for housing demand because it means that there are fewer or more people employed, better economic growth prospects, but it's bad news for interest rates because the more economic growth we have, the higher those interest rates are going to be. Our call is still essentially unchanged. We believe that the economy experienced what we've been calling a rolling recession that really got started at the start of 2022. So if you look at this slide, you've got 2 quarters of decline in early 2022. It was not designated as an official recession at that time because the unemployment rate remained low, but that's because we're in the midst of a demographic labor shortage. So, the academics, this gets into kind of angels dancing on the head of a pin, or is Pluto a planet type definitions. They will squint and do their analysis a year or 2 years from now. I think they're going to basically designate some portion of time here in 2022, 2023 as a mild recession. But the fact that it's not, kind of a much bigger decline, a more rapid decline, means that the bond market right now has higher interest rates in place than many economists expected.
Okay. And explain to me or give me some definition of a rolling recession and maybe some context in the last time our economy has experienced that, so people can go, oh, okay, that's what that feels like, or that's what that looks like, and I kind of can relate to that.
Yeah, so let's benchmark it to the 3 prior recessions we've actually got marked officially on the table. So of course, 2020 is COVID. That's where the government shuts everything down and you get a recession. Then you've got 2008, 2009. Now that is a financial crisis with a deep recession, and you can see the impact there on the GDP growth rates. That was a once in a century type event. 2001, 2002 is more your typical recession. It's, kind of moderate recession. You've got some periods of GDP declines, higher interest rates slowing the economy. A rolling recession would be where different sectors of the economy decline at different moments. So, for example, we know starting in March of 2022 through roughly the end of last year, the housing market was in recession. In other words, you saw declines in housing starts. The actual level of construction activity fell 10 to 20%, rising cancellation rates, declines in sales. Similar impacts were felt in the manufacturing sector. The manufacturing sector weakened. But at the same time, you have the service sector growing. Now, why is the service sector growing? Well, because of the 2020 recession. The service sector was rebounding, reopening from some of those COVID losses. So it doesn't fit quite the textbook definition of a recession, which is a broad, multiple sector decline in economic activity with a rising unemployment rate. Rather, things are spread out over time. And that's what makes this one a little bit different and a little bit more difficult to classify.
Right. Thanks, Rob. I appreciate that. Okay, let's talk about jobs.
So actually, this morning we got an update on this data. This is a look at the labor market. The red line is the unemployment rate. I think it's what we all kind of think of when we think about the health of the labor market. The unemployment rate remains below 4%, and to home builders and multifamily developers and apartment operators, that's good news. Lots of people employed, low unemployment rate, certainly good for the overall economy. For the Federal Reserve, it's bad news because what they see there is a tight labor market, and what they're scared of is a return of the 1970s. So that's a tight labor market that produces wage gains, which then makes the inflation challenge that much more difficult. The other way to kind of look at the labor market is the blue line here, and that's the job openings rate. That's what we got the update on this morning. This is a measure of the number of opened, unfilled jobs in the US economy. So you can see it trending higher since the Great Recession. This is as we get a deepening skilled labor crisis in the overall economy. We'll show this data for the construction industry specifically a little bit later. A little bit of weakening during COVID, of course, as we saw a spike in the unemployment rate. And then the economy reopens in 2021. And what happens to that blue line? It absolutely jumps. So what's happening there is, particularly in the service sector, lots of businesses now experiencing what home builders and remodelers have experienced the last decade, which is a real challenge in recruiting and retaining workers. So the job openings rate increases, which means lots of help wanted signs out there, lots of jobs that aren't filled. And then in the first quarter of 2022, as the Federal Reserve begins to tighten financial conditions, that job openings rate turns and begins to trend lower. So we've got in the subheading about 10 million open jobs in April. What's striking about that number is there's only about 5 to 6 million unemployed individuals in the US economy. So you could literally take every single person who's unemployed, put them into an open job, you would still have millions of open jobs. So this morning, actually, we got a little bit, this again, this sort of weird bad news is good news. The number of open jobs fell to about 9.8 million. So that trend lower continued. That's actually helping us on the interest rate story. And our estimate is that we need to get down to about 8 million open jobs for the US economy to have slowed on the labor market side, such that the Fed feels like it's making some progress in cooling things down.
Gotcha. Okay, thank you. Let's move on to more labor issues or labor data.
Yeah, so a little bit deeper dive on the labor data. Part of the challenge is getting those workers in. So I mentioned before that we've got roughly twice as many open jobs as there are individuals out there to fill them, unemployed. So, what economists use to look at this is the labor force participation rate. And the challenge here is, one, it's been declining for a while, but two, the impact that was felt during COVID when we had several million workers move to the sidelines, that recovery has been incomplete. So it says 63 to 63%, but you can see there in the line, it's been an incomplete recovery. We still essentially have 1 to 2 million individuals who moved to the sidelines, stopped looking for work, and who have never come back to the labor market. So that rise in the job openings rate that I showed you in the prior slide is in part due to this. Now, why are we putting this up here? The Federal Reserve can't control the labor force participation rate. This is something that other government policies or just the market forces themselves are going to have to undertake. And it's one way to kind of reassure the Federal Reserve that we're not going to see runaway wage growth, which could turn into inflation. So we need to encourage the Department of Labor and state and local governments to really incentivize individuals coming back in the labor market, and that would help fight inflation and require the Fed to do less. And that's really what we want. We want the Federal Reserve to have to tighten less in terms of housing demand.
And do you see those policies some action being taken on those policies, either at the federal level or at the state or local level? I mean, what are you seeing happening, and do those government entities get it, or are they kind of waiting and watching the Fed?
Things have gotten better. It's kind of interesting. If you go back to 2014, 2015, when our industry began to really kind of raise the alarm of the skilled labor crisis in construction, there were a lot of academics and think tanks who basically said we were making this up, that there was no labor shortage. And obviously the COVID experience, I think, has now proven them completely wrong. So I think the talk has improved. In other words, when you talk to governors, when you talk to lieutenant governors, when you talk to leaders of trade schools and community colleges, they're taking this seriously in terms of trying to get more workers into the labor market. And of course, you have groups like the Home Builders Institute, HBI, which and Lowe's and Home Depot who have programs to try to recruit workers into the sector. So there is definitely some improvement in activities. Do we have full buy-in yet? No. And this is something where I think, in particular, the Biden administration, the Republicans in Congress could do a better job on.
Okay. And are there particular, I mean, is there an example of a policy? And you mentioned, obviously HBI and others like them that are, community colleges, others that are kind of encouraging. HBI has been doing it forever, but I mean, there's more activity at the local level in terms of community colleges and even high school programs, kind of reinstating those kind of trade programs. But
Yeah.
is there a particular policy that you'd like to see at a federal or state level that just either isn't being done or is kind of slow in coming to fruition?
More focus on training for jobs that are in demand. So, one of the kind of striking stats is if you look at high school graduates today, 80 to 85% are going to go to 4-year colleges, but only 60% of that group is going to graduate with a degree. So we're essentially causing our labor force to be smaller because they're going to get training for jobs that they're not going to fill, for degrees they're not going to undertake, and then they're going to accumulate student loans. So we need to improve the targeting of our education policies. The other factor, and this is part of the sort of the connection to the long run decline in the labor force participation rate, is dealing seriously with the opioid crisis. And we still have 80 to 90,000 Americans dying every single year due to opioid abuse. And what's striking is what we went through with COVID, shut down the economy, lots of stimulus, taking that very seriously, but not taking this issue more seriously. And you can get into the politics of this. Maybe it's a different group of people who are affected, but I think targeting our education policies better and then dealing seriously with the opioid crisis would lift the labor force participation rate.
Okay, thanks. Appreciate that, Rob. Let's talk. Let's look at a little bit more detail here for men and women.
Yeah, so this is something we've been highlighting for a while. My wife is actually an economic historian, so anytime we talk about economics, I'm sure you're real jealous of our marriage here. But she always reminds me, it's not just 2000 to today that matters, but look at it kind of deep by decade. So this is data that goes back to 1948. So we're looking at the male labor force participation rate, and you can see the impact of COVID at the end, but it's kind of a footnote to the longer run issues. And it gets to what we were just discussing. Why has male labor force participation rate gone down so much? Now, part of it is an aging of the population. So there's more retirees. But then if you throw in factors like opioids, just people sitting on the sidelines and not looking for work, maybe because they're not trained, they don't have a career path in front of them, you get this impact here. And I've been telling audiences, this is probably the saddest slide I think I've produced in my 20 years in doing housing and economics, is that this kind of long run decline. So here's an area where the construction industry in particular can play an important role because we are 95% male. Now, we need to do a better job diversifying the industry. But again, working with community colleges, working with trade schools to try to lift the male labor force participation rate is important. And it's important for the Federal Reserve too, because if we get more workers, anytime you increase the supply side of the economy, you're going to get more output. And with more output, those inflationary pressures are going to be reduced.
Right. Okay. And then by contrast, let's look at women in the workforce.
Totally different story, right? So yeah, again, I mentioned my wife being an economic historian. Again, we're looking at data going back to 1948, right after World War II. The female labor force participation rate increased roughly to the late 90s and then began to level off. So this is just a reminder that within the construction industry itself, we've got to diversify the industry. Only about 5% of construction workers are women. I think some of that change is coming. You've got groups like the Professional Women in Building Council within NAHB, other groups. And this means not just within the trades, but of course also owning and operating building companies and remodeling companies. This will come in time, but it's an important part of solving the skilled labor shortage in construction.
Right, right. Okay, great. You talked about wages and productivity. So what does this chart tell us? And it seems like toward the end, after middle 21, some things kind of really radically changed.
This is where the Federal Reserve develops that kind of heartburn looking at some of the labor market data. So the red line here is the growth in wages. The blue line is labor productivity. Wage growth in a market in equilibrium, kind of a chalkboard model of the economy, wage growth can grow with productivity. You can pay a worker more when they're producing more output per hour or per week. So generally speaking, that red line and the blue line are moving together. What's kind of interesting in 2020, when we had a large part of the population working at home, basically moving economic activity from the commercial office into the home and into the home office, productivity went up. Now, there's a debate over why that is. Maybe it was people were scared of losing their jobs in 2020. I tend to think that if you have people commuting less, they're going to be more productive. I know managers would probably disagree with me, but if you look at the data in 21 and 2022, labor productivity is now negative. That's a problem for the Fed, because wage growth, the red line, is still positive. In fact, it's above the trends that we saw, say, back in 2014 and 2015. And so now you have nominal wages growing, productivity declining. And so that gap between the red line and the blue line is an inflation warning. So what's the Federal Reserve going to do about that? Well, it wants to continue raising rates and push that red line down. I would argue as a supply side economist that the other thing that we can do is encourage other parts of the government to try to lift the blue line up. That's the other thing. So anything that we can do, whether it's regulatory policy, worker training, investment in human capital to increase labor productivity is going to essentially result in the Federal Reserve having to do less. And that's kind of the goal here.
Yeah. Well, it looks like the trajectory of the earnings has kind of steadily gone up, and productivity's kind of bounced around a little bit more up until COVID, and then obviously that's kind of an anomaly.
Yep.
But wages and productivity kind of followed a track for a while, almost identically, and then wages jumped back up while productivity kept going down. Yeah, it just seems to me that's. I mean, what was there something that happened at that moment where productivity kept going down, but wages started going up? Was there a catalyst for that, or an explanation?
Yeah, just the huge amount of stimulus that went
Okay.
into the economy in the midst of a labor shortage meant workers could demand higher wages. It was easier for startups and other businesses to obtain capital, so they could get away with higher nominal wage growth. The productivity story, like I said, is a little more complicated. I think some of it is COVID. I do think there was a one-time productivity gain by having 30 to 40% of the workforce work from home more often. I think often if you save someone 2 hours of commute a day, they might have been working 1 hour more, and that resulted in a lift in output. Like I said, I know a lot of managers, a lot of builders I've talked to in-person audiences do not agree with me on this one. But as a housing economist, I got to say, I think it was a validation of what houses can do.
Right.
That if we took some work out of the commercial office, out of the urban core, and put it into the suburban home, it was actually a good thing for the economy, and it's a good thing for demand for remodeling and new construction.
Well, it's hard to argue when you look at a chart like this. So yeah. Okay. Okay, now we're going to talk about the Phillips curve, and so you need to explain what that is, and then we can talk about what you're showing here.
Yeah, so yeah, we're going to do a little bit of theory and then kind of take a look at the data and see if the theory actually works. So,
Okay.
the argument, I think many people are familiar with this, is the Phillips curve date from the 60s and 70s when a much larger part of the US labor force was unionized. And the idea with the Phillips curve is it says if you have a low unemployment rate, which would be on the left side of this graph, you will have a high inflation rate. And the argument is that when the unemployment rate is low, workers, particularly through unions, can demand higher wages. Those higher wages then result in higher costs for businesses, which then results in higher prices, which is inflation. If the unemployment rate goes up, in other words, if the Federal Reserve slows the economy and you move to the right side of the graph as the unemployment rate increases, the inflation rate goes down. Now, so all the discussion, and for example, tomorrow we're going to get the job market report for June. Anytime you see good job news, big job creation numbers, and then the market goes down, they're basically in thrall of the Phillips curve. The idea being that the unemployment rate is low, and therefore we're going to have higher inflation, higher interest rates, and that's going to, of course, reduce housing demand and reduce stock prices. But the question is, and this is something I think particularly for younger and maybe a little more conservative economists, does the Phillips curve even really apply? So if you advance to the next slide, here's the data. This is quarterly data. Every dot on this graph is a quarterly data point going back to 1948. And if the Phillips curve applied, you should see all those dots concentrated in basically a diagonal line that looked exactly like the theoretical curve that we showed in the prior slide. All right, no, it's a blob. And not only if you try to draw a trend line through it, which is really kind of a heroic feat of statistics, it's got the wrong slope. So most economists who look at the data, and you can cut this data up, you can look at it just in the 70s or the 60s, there really is no statistical relationship between the Phillips curve, which is ironic because the business news press spends so much time talking about the connection between low unemployment and high inflation. I wish they spent more time talking about productivity. And that politically matters too, because if we talk more about productivity and less about a tight labor market, maybe we would think about regulatory policies that would really help businesses increase output. And that's what we want.
Right. Excellent. Okay, thanks.
So, then the question comes up, okay, well, if you're kind of telling me that, yeah, the labor market can be tight as long as productivity is going up, what's the reason for all the inflation that we've had over the last 2 years? And I got to say, we got to kind of go back to first causes. We kind of already talked about it, but this is government spending since, basically looking since the year 2000, but look at the 2020 to 2022 periods. You have multiple waves of a huge amount of stimulus, absolutely huge. I mean, go back and look at 2008. That little uptick you see is the American Recovery and Reinvestment Act. And for those of you who were in the industry back in 2008, 2009, you remember it was a little less than $1 trillion. Compare that to the $9 trillion of fiscal and monetary policy stimulus that we pumped in the economy from 2020 to 2022. We did not increase output for the US economy by 9 trillion, but we increased the cash supply. All right, so what happens when you have more cash chasing basically a fixed amount of goods and services? Prices are going to go up. So what you're looking at, I think, is really kind of the true cause of the inflationary pressure. And so, yeah, we can criticize how the Federal Reserve is going about things, and we'll talk about the Fed policy here in a second. But to give the Fed its due, they are trying to clean up somebody else's mess. That there was too much stimulus in the COVID era, and now they're trying to drain that liquidity out and return price stability back to the U.S. economy.
Gotcha. Okay.
So let's take a look then at some of the internals on the inflation data. What you're looking at here are two sources of inflation. The blue line is commodity inflation, and that blue line looks an awful lot like the lumber price experience that we had, lumber prices shooting up and coming down. And the reason for that is because a lot of that commodity inflation was the increases and declines in lumber prices. The red line is service inflation. So this is non-goods based inflation. This is the cost of healthcare and legal services and business services, the non-commodity part of the US economy. The commodity inflation story is telling us that much of the work in fighting that kind of inflation has been done. And think back to what you asked about a rolling recession.
Yeah.
We said construction and manufacturing. Those are two parts of the economy that really draw on commodities as inputs. So as those commodity prices came down, we got some cooling in the demand for those kinds of economic goods. The service economy, which responded later because it was subject to COVID era lockdowns, is the part of the economy that's really generating a lot of the inflationary pressure right now. And if that's what the Federal Reserve is thinking about in terms of tightening additionally from where we are right now.
Gotcha. Yeah, that's a perfect example of what you were talking about when we talk about a rolling recession, of seeing the difference between the service and the commodities. Terrific.
So then if we look at the internals on service inflation, the most important one is the red line here, which is shelter inflation. In fact, shelter inflation is 40% of the CPI. So the blue line here is the consumer price index, the broadest, most basic measure of inflation. Now, two things you can kind of take away from this. One, the blue line did peak last summer and has been moving down. Has it been moving down fast enough? No. But the Fed wants the CPI to get down to about 2.5%. And part of my messaging to the Federal Reserve staff is, what's the rush? It seems like recently we've gotten impatient. We're moving in the right direction. We've pressed the brake on the car and we're slowing down. You don't need to raise the emergency brake to get down to zero right away. And the other part of that message is that the red line, which is shelter inflation, which is a measure of rents and owner's equivalent rent, you can think of that as home ownership costs.
Yeah.
That's been a leading source of overall CPI inflation. It's the most important part of that service part of inflation that we showed on the prior slide. Now, what can the Federal Reserve do to tame shelter inflation? Not a lot. In fact, I think every builder in the country knows the best way to tame shelter inflation is to build more attainable, affordable housing. Housing supply, the supply side of the economy. Again, this is our message to the Fed. They listen sometimes, they don't listen other times. But if we really want to deal with the shelter inflation component, that's what we got to do. The other thing to kind of keep in mind about this is that these components of CPI, it's a government data set, which means it lags the market, but it has a deep survey. So the numbers are reasonably accurate, but we're usually getting them 2 to 3 months after real-time conditions have passed us by. If you look at real-time measures of rents, which is an important part of the shelter inflation component, that rent growth has cooled way off. In fact, it's moved to kind of flat conditions. In some markets, you're seeing year-over-year declines, some markets year-over-year increases, but they're relatively small. So what does that mean if you're a voting member of the Federal Reserve? That red line is coming down, and it's going to come down over the next 3 to 4 months. In fact, if you took away the shelter inflation component of CPI right now would be at about 2%. So if we could just solve the housing shortage, the inflation challenge would be over and the Federal Reserve could go to normalizing rates. Our problem is, and this is speaking just parochially in terms of the industry itself, the Federal Reserve has basically sort of acknowledged that it can't do a whole lot to help us build more housing. That's going to be done through zoning rules and regulatory policies, all different policies that we work on throughout the Federation. And instead, the Federal Reserve is targeting that part of the economy it feels like it can have an effect on, which is something they call super core inflation. The definition of super core inflation is it's service inflation minus the shelter component. What does that mean? Well, it means that they're trying to raise interest rates to try to slow down the growth rate of wages in the retail sector and the growth rate of wages for lawyers and things like that. I'm not sure that's a successful strategy. The analogy that one of my PhD advisors likes to use is that there's the old story about the drunk who's outside his car looking for his car keys. It's night, it's raining, and he's only looking under the light of the street lamp, and he's not looking through the rest of the parking lot. And the cop comes up and asks him, "Why are you looking just there?" And he says, "Well, I can see here, so this is the best place to look." That's where the Federal Reserve is right now. They're just looking at the place where they feel like they have some control. And the other analogy, of course, is that the Federal Reserve is driving with its rear view mirror. They're just looking at the backward looking data. So housing is an important part of the inflation story. And ultimately, the solution for a lot of this, particularly if you're thinking about moderate and low income households, is to build more housing.
Right. Right.
So here's the kind of where the Federal Reserve is. The red line is the Fed funds rate. That's what the Fed controls. The blue line is the 10-year Treasury rate. Now, this slide was created a few weeks ago, so you can see that blue line. It's kind of at 3.7%. This morning, that blue line has now jumped above 4%. So what we're seeing is the long-term interest rates begin to chase up the red line, which is right now at 5.25 after the May Federal Reserve increase and the June pause, because they did not raise rates at June. What do we think the Fed's going to do? Well, we think they're probably going to increase in July. And I think it's 50-50 on whether they increase in September or pause in September and then raise at the next meeting after that. So we likely got another 225 basis point increases. I should note my bias here. About 2 or 3 months ago, I was saying they'd get to about 5.25, and that would be it. So this is an upward revision on the terminal target, but that's based on the commentary that the Federal Reserve has basically given us. And the reason those long-term interest rates have been creeping up over the last week is the bond market is basically capitulating to this idea as well.
Right.
The thing that we've been saying, that we've been consistent about this for about a year, is the Fed is not going to cut in 2023. The bond market was really expecting some rate cuts at the second half of this year. That's another reason that the long-term interest rates are going up. They're not going to do that. Right. Chairman Powell has said since the Jackson Hole Conference in 2022, higher for longer. So keeping that red line elevated until inflation comes down, the CPI comes down at least until it declines below 3%.
Okay. Talk about bank deposits. Sorry. So why we need to pay attention to this too?
Little boring graph, but boring is good on this one, right? This is the level of bank deposits. The blue line is for the biggest banks, a little more volatile. The red line is for the small regional banks. Now, the red line, that deposit base is absolutely critical for the source of builder and developer loans. So you can see the red line shifting down just ever so little bit in 2023. That's the Silicon Valley Bank failure. And we had 3 bank failures. There was concern that any deposit above the FDIC limit of 250,000 was at risk. And so some depositors, not a lot, moved their funds from those regional banks to the too big to fail big banks. Now, there was concern, and including by myself, that we were going to see a big drop in the red line, that the deposit base for those small banks was really going to move lower. And in fact, it only proved to be about a 5% decline. That's good news for builder and developer loans. I put this slide in the deck, though, because I think that the Federal Reserve basically emerged through that situation a number of months ago without causing a financial crisis. And I think they've now become overconfident. And here's the reason why. As long-term interest rates go up, all of the bonds on the books of these smaller regional banks, the value of those bonds, the price of those bonds goes down. Interest rates higher, bond prices lower. So they're sitting on right now about $600 billion in paper losses. Higher interest rates, the 10-year treasury rate, for example, getting up to 4.1% is going to increase those losses. So the Fed right now is navigating a really difficult challenge where they're trying to bring inflation down faster. Again, I think they could go slower and still accomplish the task. As they try to bring inflation down faster, they are risking a financial crisis with the regional banks. And that, I don't think we sort of navigated that fully. And I think, unfortunately, some of the voting members at the Fed right now are being overconfident about this situation, feeling like they fixed it. They only lost 3 banks. We can proceed with raising rates.
Well, yeah, only lost 3 banks. And that's a good point to make because it seemed like, and again, just general media, whatever the coverage was, it was just, this could be a financial crisis. And certainly it could have been. And I think, like you said, the Fed managed that fairly well. But going forward, part of the reason I shouldn't speak to this, but that Silicon Valley did not see the losses that are still being incurred by banks as interest and bond rates are going up. And that's what caused a lot of their problems, or their problem. They just couldn't cover. And so, who's to say, given what you've said, that other banks, other smaller banks might be in the same financial trouble and more of them could fail? Is that kind of where you're going with the Fed being overconfident?
Yes. And in my conversations with lawyers and economists at the Fed, I think they have a feeling that those 3 bank failures were due 100% to bank mismanagement. It was the leaders and owners of those banks not properly hedging interest rate risk. Well, yes, but it's really difficult to hedge interest rate risk. And we're not concerned about those 3 banks in particular, but the broader financial system when you raise interest rates as quickly as you can do, because you can only hedge a certain amount of unknown activities. So
Right.
I think the risk is if they keep pressing that break even higher, we're going to see more and more bank failures. We will have more bank failures. It's coming. And right now it appears to be that's the one thing that convinces the Fed to move slower.
Okay.
So we're putting that on there because, when we think about interest rates, we often think about mortgages, but the health of the regional bank system is absolutely critical for builder and developer financing.
Right. That's a great point. Okay. Let's get into a little bit more Fed, their balance sheet and what's going on.
So almost done on the inflation section. So, we talked about the regional banks kind of health. Here's the Federal Reserve's balance sheet. This is the amount of essentially treasuries and mortgage-backed securities that they buy to keep long-term interest rates lower. It's quantitative easing. You can see that the first time they really did this was back in 2008. And at the time, it was radical. It was considered huge. And then they kept building them up in the 2010 to 2013 period, another step up in 2014. And then they finally got to a level and said, okay, we got to unwind this. So there was kind of a slow period of unwinding that really got started in 2018. Then COVID hits and they add another several $1 trillion of cash by buying debt. And that's what quantitative easing takes. So that continues until 2022 when they say, okay, now we need to unwind, and they begin quantitative tightening. And then what happens in early 2023? Those three bank failures that we just started talking about. So the fact that all these banks had paper losses, what did the Federal Reserve have to do? Well, they opened up the lending window. They said, rather than selling your bonds, which have paper losses, you can borrow from us to try to cover any potential bank run, so that there's not a Twitter-induced bank run that would result in you not having enough liquidity. And so you can see at the very end that little spike up in the size of the Federal Reserve's balance sheet. That was that lending. Again, I don't think the Fed has sort of fully digested the fact that that will likely happen again. So don't look for a big decline in this period of balance sheet reduction, but it is one of the factors. Anytime this line goes down, it pushes mortgage interest rates up.
Okay. Okay. Good to know.
So, all right, now we can put all this together. We've kind of gone through some of the theory and practice of monetary policy and the inflation data.
No, but that's important because we can't get here. We can't understand this until we go through that. So I'm glad you did that. That was awesome.
And, you know, this is probably a good point to say all economists should, particularly in the post-COVID period, should have a certain amount of hubris as sort of keeping us humble. You know, we're in a new environment. So, you know, some of these things, you know, we're going to learn as we move through it. But here's where we really care about. The red line is the 30-year fixed rate mortgage. The blue line is the 10-year treasury rate. The blue line is crept back up to 4%. And we did have in our forecast, and everything after that red vertical line is our forecast, we did have an additional period of rate increasing. So that's proven true. It has though gone up higher than what we expected. So that blue line really should now be above 4%. So we expected one last period of higher mortgage interest rates, and we've begun to see that. The Freddie Mac average this week was 6.8%. Just a few weeks ago, it was 6.7. Next week, in other words, mortgages enacted at the end of this week and the start of next, we're going to see that number get up above 6.9 and approach 7%. The open question really gets to the headline of the slide, which is, are we going to get above the 7.1, 7.2% 30-year mortgage interest rate, which right now was the peak of this cycle? So the bond market capitulating, expecting the Fed to do more, means that we are in this kind of short-term period where rates are going up. But then once we get to finally when the Fed stops, and I think it's going to happen this year, and then begins to ease, and I do think that happens in the middle of next year, that red line begins to settle in. So ultimately, thinking about the calendar year 24 and 25, we are going to see mortgage interest rates settle in at 6% or just below 6%. And that's a workable market. So the remarkable thing is that the housing market has shown resilience. I think a lot of that is due to lack of existing home inventory. We're in for some tougher weeks here now that housing affordability conditions are declining and the Federal Reserve is talking tough. But ultimately, if you're looking a year or a year and a half down the road, those rates are going to move lower.
Gotcha. And I think the historic look at this too is important to put it in perspective and put it in context. I mean, you know, we went through a period of extremely low interest rates, mortgage interest rates, and you know, historically we've been well above 6 before, and much higher. So, you know, this isn't great news for housing, but it's also just not, you know, it's not like it was even in, you know, when I bought my first house, I think I paid something like 12 or 13%. You know, it was in there.
Yeah, that's my dad likes to remind me he bought his first house at an 18% mortgage interest rates. The price to income ratio was a little different back then.
A little different, yeah.
Yeah. And then, you know, I mentioned hubris and trying to be humble with some of the forecasting elements. This is the difference between the 10-year treasury and the 30-year fixed rate mortgage. So you can think of this as the gap between, on the last slide, the red line and the blue line. And in the post-Great Recession period, this line is about 160 to 180 basis points. 2016, 2017 is kind of a typical period. There's a lot of financial stress in early 2020, but it's the 2022, 2023 numbers that are really kind of compelling. That 160 basis point spread is now roughly 300 basis points. Part of that is the balance sheet unwinding. When the Federal Reserve sells mortgage-backed securities, it increases interest rates. That's quantitative tightening. Some of it is market risk, just a risk premium that's going on top of the 10-year treasury into the mortgage market. And then just some of it's just sort of the general macro conditions. So, when we think back and we look back at our forecasting mistakes, we didn't expect mortgage interest rates to really get up above 7% when we were thinking in late 2020. So, going back 3 years ago. And the reason was that we were expecting this spread to top out at 200 basis points. If that spread had topped out at 200 basis points, today mortgage interest rates would be below 6%. So that's adding an additional 100 basis points to mortgages. I do think ultimately we're going to get back down to 200, 220, but not anytime soon.
Okay.
And then just lastly in this section, we talked about the banks, we talked about the Federal Reserve, the overall economy. What about households? Just basic housing demand. Households are actually in pretty good shape. Now, part of that is what happens when you pump a huge amount of stimulus into the economy. But the red line is the mortgage debt to disposable income ratio. So it's literally the amount of money that the entire country is spending on principal and interest payments. Look at where it was in 2008. 7% of national income was going to pay for mortgages. That was the housing bubble. There was too much speculation going on. It then comes back down. I would say any number under about 5% is fairly healthy. Look at where it is today, 3.9%. From just a pure housing perspective, households have a lot of dry powder to deploy to qualify for mortgages. Now, there are other sources of financing and they're crowding things out. And you can see the blue line is one of them. That's overall consumer debt, disposable income. It is true that we're seeing more people spend money on credit cards, auto loans, and here's the big one, and has been for the last 10 years, student loans. 1.8 trillion in student loans. Yes, we've had this kind of student loan pause for the last few years, but the Supreme Court, basically said President Biden can't spend $400 billion without getting congressional authority. So at some point this fall, you're going to see a lot of those individuals who have not been paying student loans will begin paying again. So that blue line, if you're looking for some weakness for households, it's really on the consumer debt side. I get asked a lot, what debt variables you're looking at to see where households might begin to really experience recession type risk. Auto loans. Auto loan financing in the last 10 years, the terms have gone longer, the rates have moved higher. There are auto loans right now with credit card level interest rates.
Right.
And if you start to see defaults and late payments on auto loans, that's the canary in the coal mine for households. But right now, for the housing market, if you're thinking about defaults, delinquencies, those traditional sort of recession areas where you'd be concerned about this sort of negative housing supply that comes to the market, we don't have that kind of environment. We have a housing deficit combined with relatively healthy households. So that the housing market is actually one of the healthier parts of the U.S. economy right now.
Right. But you look at that consumer debt, not just mortgage debt, but consumer debt, like you mentioned in student loans, particularly, and maybe even automobiles. You're talking about, a good percentage, I would think, at least of the student debt of younger households. And so they're under a situation where they might, as part of their affordability or attainability aspect, they have so much debt, maybe specifically student loan debt, they can't afford a house. They can't get into a house. And I don't want to overstate that, but I think that's got to be part of why we need to supply more houses just in general, but more houses that are attainable.
And that is consistent with the forecast we'll mention in some of the later slides, but we expect the homeownership rate to post some overall declines because of those younger households, not existing homeowners losing their homes, but younger households unable to attain homeownership. And then we do expect some weakness in the multifamily market because I think you're going to see rising vacancy rate in rental units because of the fact that student loan payments are back online and something's got to give. And the way that give could come is saving money on rent. And that could be moving in with, doubling, tripling up on roommates or moving in with family.
Right. Okay. So the next section we're going to talk about is supply side. So let's
And
get
we
into
can go
that.
through some of these relatively quickly as we kind of move our way to the final section on sentiment and outlook. But we talked about commodity inflation coming down. Here it is for our own sector: residential building construction costs. On a year-over-year basis right now, those costs are 3% lower than they were a year ago. So we've moved a far way from when we were looking at almost a 25% year-over-year growth
Wow.
rate. And again, that looks a lot like the lumber market. And in fact, if you move to the next slide, we've got that lumber
There
pricing.
you
Now,
go.
this is
Yeah.
data from mid-June, so prices have gone up as we saw some optimism coming in the market. If you look at the futures market, a lot of growth. In fact, lumber's futures approaching $600. What's going on here? The lumber market remains fragile. Again, when I talk to builders, I say once we begin to see a sustainable rebound and single family construction, expect lumber prices to go back up because we have not increased domestic output and we still have a 9% effective tariff on Canadian lumber.
Yeah.
So the lumber market remains fragile, subject to a lot of volatility when we get these turning points in the building market. And then to add to the last slide, it's not just lumber, but of course, we still got issues with electrical transformers. Concrete prices are 12% higher. So there's still a lot of supply chain issues.
Right.
And then, yeah, you can advance
Sorry,
it to
I jumped a little
yeah,
bit.
no, the labor slide. So again, this is the JOLTS data. We went through this in a lot of detail for the overall economy. Here it is for the construction industry. We're short about 400,000 workers right now. We do expect some softening as the number of homes being built continues to decline, but this number should begin rising again by the time we get into 2024. And the big number, and this is an estimate that we do for the Home Builders Institute every year, our industry needs to be adding about 750,000 workers a year to account for industry growth. And then this is where most of it needs to be: industry retirements.
Yeah.
We just have a huge job in terms of trying to recruit individuals in the sector. And the current elevated level of open jobs in the construction industry is consistent with that.
Yeah. And this next slide, I think your
Yep.
team just put out a Eye on Housing about this, about A, B, and C conditions, and you did a survey, in fact, of builders about what they're seeing and what they're feeling.
Yeah, so this is, we talked about Silicon Valley Bank and some of the regional stress failure, the 5% decline in the deposit base, but the real effect here is just higher interest rates caused by the Federal Reserve, higher prime rate, therefore a higher effective interest rate on AD and C loans. In fact, the number that's striking to me is that the average annualized effective interest rate on a spec construction loan right now is around 12%. So 12% compared to that sort of 6 to 7% on mortgage interest rates. And in fact, in this survey, this is a quarterly survey, we do the red line, and the blue line is a Federal Reserve survey that's very similar. But for the last 5 quarters, we've had tightening conditions for AD and C loans. 60% of builders said that an additional difficulty was due to financial market stress. In other words, some of the challenges faced by regional builders. A smaller group said bank failures themselves. But, we do expect tight AD and C loan conditions. And what does this mean then 2 years down the road? It means the land development market is going to be tighter, which then means by the time we get into a real sustainable rebound on a calendar year basis in 24, 2025, we're going to be facing lot shortages. So expect volatility in lot pricing as we move back into that rebound mode in 24.
Man, okay, thanks.
Yeah, a lot of good news there. Yeah,
Yeah.
and it's just our lot survey.
Yeah.
We're still saying 2/3 of builders across the country are still saying lot supplies are low or very low. We just don't see a fix to this. It's zoning issues, it's lack of financing to land developers and the like. And this is just going to be an ongoing headache, particularly for smaller builders that don't have vertically integrated land development companies.
Right. Well, there is a, I don't want to say a fix, but there are policies that would help, as we've talked about with other sectors, labor, specifically. It's like there are policies that would help this, help ease this. as you mentioned.
Build with density, right? Yeah. If we could build more homes in a given amount of dirt, reduce those lot sizes, that seems to be what the market likes. Build more townhouses. The townhouse share right now is about 19% of single family building. I think it probably could be 25%, but zoning rules prevent it and other kinds of regulatory costs. So when we talk about that regulatory burden, it's really felt in the land development part of the market.
Yeah, that's a great segue, because that's the next thing we're going to talk about. And it's kind of remarkable to me that almost $94,000 per new home, and the gain that it's had in the last 5 years, or the 5 years that you've tracked, it's unbelievable. It's kind of unbelievable.
Yeah, this is, I just put this in here. I think many of the builders are familiar with these numbers, particularly any builder that's undertaken advocacy efforts at state and local government. But we do this survey every 5 years. It's a reminder when you're talking to policymakers, talking to the media, the problem in our industry is a death by 1,000 cuts. Each individual regulatory item or legislative item may be $1,000 here or a few $1,000s here, but it adds up. So that 94,000 is a national average. I remember I presented this slide out in a trip I did in California through Sacramento and San Francisco. The audience laughed at the 94,000, at least a $200,000 number. But on average, it's about a quarter of a newly built single family price, growing faster than inflation. Like you said, that 11% gain. We will do this again in 2026, where we survey builders and land developers. But you can look at all the sources there in the stack. I like to point out, one of the ones I hear about more and more in that yellow box, architectural standards. This is a really insidious way of essentially keeping affordable workforce housing out of neighborhoods, is to have requirements on the kinds of exterior to the house, building materials, certain kinds of paint. Those architectural design standards add cost to the market and chase out affordable housing. So this is something we have to keep engaging on. And again, it's a reason why membership in the Federation is so important.
There's a question that we have from the audience that is, I think, poignant, and at least I want to get your perspective on it. And that's the impact that ADUs, or accessory dwelling units, have or could have on helping to reduce or increase the housing supply, make housing more attainable. What's your take on its role in housing, ADUs?
ADUs actually can play a helpful role. Right now, there's about 1.5 million ADUs in the housing stock. So, housing stock's a little under 150 million all in, if you include things like houseboats and the like. So it's a 1% part of the share. It's not a perfect substitute for an apartment or a loud duplex type housing, because that's when you build an ADU, you're essentially putting an apartment into an existing owner-occupied home. But we like to think the housing market is a ladder. You need every rung on the ladder to work. And those additional sources of non-traditional housing supply can be part of the story. But they are imperfect solutions. They can't do it all. ADUs, like tiny homes, are small. They might work for one person, that sort of just out of college type student, but it's not going to work for a family. And if you look at where the housing market is really the tightest, it's that entry level 2,200 to 2,400 square foot type home, where a newly married couple with a newborn might try to locate. So ADUs, tiny homes, they're not going to solve that, but they can provide some supply in markets where it's difficult to build apartment buildings, for example.
Yeah. I want to mention to the audience, we are at the top of the hour. I mentioned at the top of the presentation, at the top of the webinar, that we would be done in an hour. We're clearly not. I think this information has been tremendously helpful, and I appreciate everybody sticking around. We're going to keep going. We hope that you'll stay with us. There's a couple of questions in the Q&A, one of which does relate to this, but I wanted to give the audience an opportunity to say, for me to say, look, we're getting close, but we've got a little ways to go. And so hopefully you'll stick with us. And again, we're recording this whole thing, so it will be available on our website in a couple of days, early next week, probably, for you to, if you need to go, you can watch the last few minutes there. One question I did get as we were talking about this particular chart, and I know this is a national average, was a question of whether there is state level data. And I know this dates back to 2021, which isn't that far ago, or long ago. But is there state level data that's available? And if it is, how would somebody get that?
In just a very few states, we have worked with some of the state associations to develop state-specific estimates using surveys. We don't have state level data, but in a few, Florida and Georgia, we do have them. The state home builders associations have access to those. This is a difficult survey to do. We need a deep sample, and unfortunately, doing it at the national level is really the only way of doing it for most places in the country.
Yeah. Okay, great. Thank you.
So we can actually move relatively quickly. This is just, I like to say there's a lot of different data providers. You know the different firms. They're all good. We got a lot of voices, but my team does produce a lot of estimates that we use for advocacy. We can move beyond this. Just you can take a look at some of this.
Yeah,
data.
I mean, yeah, and this again will be on the deck. People can stop if they're recording and look at this. But you guys do have a ton of advocacy efforts, and I think the industry appreciates that. So let's jump into sentiment.
Yeah, so just kind of wrapping up, we've kind of hinted at some of this. The remodeling market, this is our quarterly remodeling survey. Sentiment's at a level of 70. That's positive. Any score is above 50. It is off its peak. It reached about a 90 level in late 2021. Remodeling market's doing a little bit better than single family, and ultimately we think multifamily construction. And that's because we've got an aging housing stock in place. So remodelers remain confident. And if you advance to the next slide, I think the remodeling industry is where we're going to see growth. In fact, if you look at its market share right now, the remodeling sector as part of overall residential construction is the area in red. It was 31% of the industry back in 2002. It's 45% of the industry now. So remodeling combined with tear down construction in single family homes right now is about 9% of the market. Those are going to be growth areas just because of the aging housing stock.
Gotcha. Okay.
We talked about the homeownership rate. I do think this is going to post some small declines because of some of the challenges in the entry level. So expect the homeownership rate in the coming 3 or 4 quarters maybe decline down to 65 or 64%. This is going to be a big policy issue, I think, by the time we get to the presidential election. Why aren't we doing more to promote home ownership? And this is something that my advocate peers here at NAHB are planning out in terms of thinking about election themes.
Well, but yeah, I mean, there's promoting it, and I guess promoting it could be enabling it, helping folks, achieve home ownership. That's all a policy issue and a monetary issue. But I don't know that there aren't more than 66% or 64% at that point of people who do want to own a home. It's not a matter of wanting, it's just a matter of being able to.
Yeah, this is not a number that we want to push up to 69%.
Right. Yeah.
But on the other hand, when it is falling, I think given the demographics of the country right now, that is a policy failure, and policymakers should be held to account when it begins to fall. So this is partly a forecast and partly a strategy.
Right. Okay.
So then, we looked at remodeling sentiment. Here's single family home builder confidence. The bad news, it went down, the blue line, every single month of 2022.
Yeah.
The good news, it's gone up every single month of 2023, reaching a level of 55 in June. We'll have a new reading of it next week on the HMI. It has been cited by the Fed as one of the reasons that they've started to see some optimism. So we may have, unfortunately, contributed to some of that hawkish look. But Chairman Powell in his last press conference basically said builder sentiment showed signs of bottoming out, and this is what he was referring to. So the index right now is pointing to the declines being roughly over, but this is going to be a stop and start process. And those higher interest rates that we've seen over the last couple of weeks is a reminder that we will see some cyclical ups and downs as we move into a full recovery later in 2024.
Right. Okay.
And the big reason that builders have remained confident despite higher interest rates is just the lack of the blue, the existing home inventory. Right now, a third of inventory, the red, is new construction. Historically, new construction is only 12%. So when those buyers feel like now's the time to buy despite higher interest rates, they're increasingly having to consider new construction. And that blue line is really not going to move higher if you think about the mortgage rate lock-in effect. If you got a 2 or 3% mortgage, you don't want to give it up to go get a 6 or 7% one. So that's going to hold down the blue inventory, which is generally speaking good for home builders.
Right. Right.
And then lastly, multifamily. We just redid the survey here, so that's the reason for the asterisk. But this is one that I keep waiting for the blue line to come down. That's the level of multifamily starts. It remains really strong. All of our members in the multifamily space keep telling me a slowdown's coming, a slowdown's coming. And then we get the monthly starts data from the Census Bureau, and multifamily construction is really strong. So I'm almost getting to the point where I think the census data might be wrong. I actually suggested this to the White House National Economic Council. It was like I made fun of their dog. They got really upset at questioning their data.
Don't question census, Robert. Come on.
Yeah, I know exactly.
That.
But you know, if you look at our survey, we have had some recent declines in sentiment, and it's because financing's got more expensive, and we're concerned about a slowdown in rent growth. Good news for the Fed. Some more challenging news for the multifamily sector.
Right. Absolutely. Okay.
And then just kind of wrapping it up, you know, this has kind of been our outlook for the last year and a half or so, but 2024, the Fed's going to ease, interest rates should settle in. Single family building will post an increase next year. And then we're maintaining this based off of the housing deficit numbers that we've got, which are a little smaller than most, but we still think we've got a deficit of about 1.5 million homes. 2025 through 2030 with slightly lower interest rates than what we have now looks like a good runway for home building growth. The 2030s, they're going to be more challenging. Interest rates will be higher. Social Security and Medicare are going to be issues, got some other fiscal policy issues, but the back half of this decade looks pretty good for home construction. We just need to navigate this one last gasp of higher interest rates for this cycle.
Right. Right. Okay. Excellent. Thank you. That was all terrific, and a great way to kind of end it with this outlook of what you guys are seeing. So I do want to remind the audience and thank those that have stuck around for sticking around. Appreciate your time. Again, this webinar is being recorded, and the recording will be available on probuilder.com/webinars probably early next week, for sure early next week, if not before the weekend. And then with that is a free downloadable PDF that's a summary of some of the most of the key slides in this presentation that you can get and have as another reference to what we talked about today. So you know, we're over time, and I don't know, Rob, if you can stick around just for a little bit, we can go through some questions. They've come in kind of a flurry at the end here.
Yeah.
But let's see. And this is a question. I don't know that there's a clear answer, but maybe there is what % of the economy is the new housing market? Is there a way to articulate that?
Yeah,
I mean, maybe
that on that slide that we skipped over was sort of the stats my team produces. We do the home building and housing share of the economy. Housing share of the economy right now is about 17%. The home building share is just under 4% of the economy. So 4%, it's actually, you know, a huge number if you think about how big the U.S. economy is. But the real critical part is that we're one of the more cyclical components of the economy. So the Federal Reserve really does pay attention. So we're 4%. We're probably about 20% all in, but we're one of the more important sectors because we lead the cycle in terms of interest rate effects. Right.
Okay. Number of questions from Robert August, who I think is well known in the industry. He's interested in when we talked about remodeling and the growth of that market and the prospects for that market of home equity pushing remodeling, especially with so little existing home inventory or even new home inventory relatively. Is that kind of where it's getting its fuel?
Yeah, decades of wisdom for Robert. So, yeah, good question. Yeah, when we think about the strength of remodeling, it's counterintuitively, we used to say, you know, the remodeling sector is helped when you have lots of existing home turnover, right? You know, you put a home in the market, you take the home off the market, there's a lot of remodeling activity. We actually have the opposite effect right now. The fact that people are going to stay in their homes longer because of the mortgage rate lock-in effects, some other issues in terms of housing affordability, that means people are going to reinvest in their homes. And we talked about work from home being a productivity increaser. Well, the fact is that people are using offices less and they're using their homes more. And that means systems failures for things like plumbing, HVAC, just the overall use of the home. So if you get a demographic change, you're working from home more, you're more likely to reach out to a remodeler. So a lot of the remodelers in our surveys say that they've got a significant amount of backlog. They've got customers who are waiting to get, basically waiting in line to get projects done. So it's one of the reasons we think the remodeling sector will basically emerge through this cyclical downturn without a lot of market decline for that particular subsector.
Right, makes total sense. And kind of building on that, the work from home aspect, and we talked about that earlier in the productivity side, but talk to me about your insights, your thoughts about repurposing non-residential buildings, office buildings, even industrial buildings, retail into housing. Is that I've heard talk of that. I know it's challenging, especially for older buildings, but or maybe newer buildings, actually. I'm not sure. But what's your take on that in terms of its effect potentially on housing stock?
Easier said than done.
Right.
It's a conference favorite, particularly among economists, to say, well, we've got too much of this real estate. We need to add additional housing, particularly in urban core areas. In most cases, those buildings, if you think about an office building, is going to have to be torn down to be turned into condos, to be turned into rental housing. Yeah, you can have a windowless office. I'm sitting in one at the NAHB headquarters. You can't have a windowless rental unit or a condo unit. So, those buildings have to be repurposed. I think where we've seen real momentum is more in the medium density environment. So if you think about a failed shopping mall or a retail center and turning that into townhouses or an urban village, there's real momentum. And there's a good example, probably about 3 miles from where I'm sitting in Northern Virginia, a shopping mall off a major highway, and it's now being converted into a hospital complex and an urban village with townhouses and low-rise multifamily. So I think we're going to see a lot of that. So it's not just ADUs as a source of housing supply. It's not just tear down construction and remodeling, but it is going to be some of that retail and office converting over to residential. It's slow and it requires a lot of public help, zoning help, sometimes public resources for site development, cleanup funds, things like that. But the communities that can facilitate it, they're going to grow and they're going to attract jobs.
Right, right. Excellent. Okay. I think that's the run of questions. If there are some other ones, we'll answer them offline individually. But again, Rob, this has been terrific. We appreciate your time and certainly your insight and your team's insight and the work you put into this. So thank you very much. And we'll let you go and get on with your week.
Thank you, Rich.
All right. Take care.